Thank you for watching module number 3. This is where we talk about interest rates on your student loans and the capitalization of interest. Now, you probably know that interest is just the cost of borrowing money, and the way it works is it's expressed as a percentage that's applied against the original amount of your student loan, and the original amount you borrowed is called the principal or the principal balance. Now, once again, most of you, if not all of you, when you're borrowing, you will have federal direct loans. For many of you, that's all you will have in your student loan portfolio. And the rates on federal direct loans are fixed for the life of the loan. They will never change. But listen carefully. The rates change on new direct loans each July 1. So, for example, if you're a student in veterinary medicine, a vet med student, and you take out a direct unsubsidized loan each of your 4 years of school. When you graduate, you'll have 4 direct unsubsidized loans, and each one of them will likely have a different fixed interest rate. If you're not sure what the rates are on your student loans, especially if you've already taken out loans, you can go to studentaid.gov, and when you log in, there's a dashboard that will list a lot of information on your individual loans, including the interest rate, and you can always see your interest rate if you go online with your loan servicer. Campus-based loans and private loans. For campus-based loans, the rates are usually fixed, sometimes at 5%. If you're not sure, you can check with your financial aid office. Private loans tend to have fixed or variable rates. You can always check the disclosure statement for your loans to see what the interest rate is. Now let's take a look at current interest rates. And folks, these are for new loans, new direct loans dispersed on or after July 1, 2020. For undergraduates, the rate on direct subsidized and direct unsubsidized loans is 2.75%. And once again, that's fixed for the life of the loan. For graduate and professional students, the rate for direct unsubsidized is 4.3%. And for Direct Plus, also called Grad Plus, you'll notice it's 1 full point higher, 5.3%. By the way, the rate on Grad Plus is always 1 full point higher than the rate on direct unsubsidized for graduate and professional students. So once again, these are rates on new loans dispersed on or after July 1, 2020. Now you'll notice we have highlighted in red in response to the coronavirus pandemic. The CARES Act was passed, and that has set the interest rates on all direct loans, including direct loans you would have taken out before this year. The CARES Act has set the interest rate on all direct loans at 0% from March 13, 2020 through September 30, 2020. On October 1, the rates will revert to the rates you're looking at now, once again for new loans dispersed on or after July 1, 2020. Now, folks, it's very important that you understand how your payments are applied on your student loans. If you have multiple loans serviced by the same loan servicer, which again, we think is almost always going to be the case, because once you take out that very first loan and you're assigned a servicer for that very first direct loan, any additional direct loans you take out, they should be assigned to the same loan servicer. So once again, you may have a lot of different loans, but they should be with one loan servicer. And when you enter repayment, regardless of the repayment plan you're in, you're going to make one payment to the loan servicer. That's called combined or single billing. They apply that one payment proportionately against all your loans based on how much you borrowed in each loan and what the interest rate is. So for example, let's keep this simple. Let's suppose again you're a veterinary medical student and you have 4 different direct unsubsidized loans. And let's suppose that your payment, let's keep this real simple, is $400 a month. You've got 4 loans and the payment's $400 a month. The loan servicer doesn't put $100 on each loan. The payment application might be something like $85 on one, $105 on another, $95 on another, etc. Once again, based on how much you borrowed in each loan and what the interest rate was. But look at bullet number 2. If you decide to at some point be aggressive in repayment, and you either make a voluntary payment before the loans are due, perhaps during your grace period, or you start overpaying, you pay more than the minimum payment amount, you get to pick which loan you apply that extra money to. You actually usually do it online. The loan servicer can show you how to do this, and you can target the voluntary or additional payment on the highest interest rate loan. That's a terrific way to aggressively pay down your debt, and there's never a penalty for early repayment. Look at that last bullet before we leave this slide. All payments go to outstanding interest first before they are applied to principal. Now, we can't talk about interest rates without talking about capitalization. Capitalization is where all the interest that accrues on unsubsidized loans. Remember, if you have a subsidized loan and you're enrolled in school, those are interest-free to you during school, grace, and any deferment period you may qualify for. But that's subsidized loans. Unsubsidized loans, interest is accruing, and any accrued and unpaid interest is going to be added back to the principal at some point through what's called capitalization. Clearly, the less frequent that happens, the better. A very simple example. If I loaned you $10,000 at a 10% interest rate, which is exorbitant, and I decided to capitalize annually every year, then after 1 year, you'd owe me $1,000. I would take that 1,000, add it to 10, and now your principal balance is $11,000, and that's what I'm charging interest on. So clearly, again, the less frequent this happens, the better. This does not happen in school unless you have a break in enrollment. So if you're taking out unsubsidized loans, especially grad students and grad plus, don't worry that interest is capitalizing while you are in school. Interest will capitalize, though, at the start of repayment. Simple example, after the 6-month grace period on an unsubsidized loan, interest will capitalize. If you're using an income plan and you're late renewing your income plan, or if there are any kind of gaps in status, meaning you have a break of enrollment of more than 6 months, or perhaps you use a forbearance period and you're late renewing the forbearance, anytime there's a gap or a change in status, or you're late renewing an income plan, you can expect interest to capitalize. And also, if you use an income plan and you switch income plans, interest will capitalize. We have a separate module on pay and repay, and we'll talk about this in that module. We hope the information in this module on interest rates and capitalization has been helpful to you. This is the end of module number 3. Once again, if you have questions about your loans or financial aid, contact the Penn Student Financial Services Office. If you have questions about general money management, please contact Financial Wellness at Penn.